Every time prices go up, a tiny piece of your freedom disappears. Groceries, rent, gas, electricity, they don't explode overnight. They just climb slowly, step by step, month after month. And if you've ever looked at your paycheck and thought, how does this buy so much less than it used to? You're not crazy. You're watching one of the oldest tricks in economic history play out in real time. You're watching a wealth transfer so quiet and so normalized that most people don't even have a word for it. It repeats every generation. It shapes who gets ahead and who falls behind. And it hides behind a simple word: inflation. Because inflation isn't just prices going up. It's a mechanism that reshapes who controls resources, who carries the burden of debt, and who effectively owns the future. For most people, inflation feels like chaos. It looks like your savings losing power, your bills rising, your plans slipping just out of reach. It seems like something has spun out of control, like the economy is glitching. But for the people who sit closest to the money, big governments, big banks, big corporations, and the asset-owning class, inflation is not chaos. It is order. It is the operating system. Inflation is how the modern financial world breathes. It's how governments pay for wars and ambitious programs without openly raising taxes. It's how corporations let old debt slowly evaporate. It's how people who already own assets watch them multiply in nominal value, while everyone else tries to chase the moving target of enough. So, the real question isn't, why does inflation happen? The real question is, why is this system allowed and designed to produce inflation again and again? To understand that, you have to step back into a world where inflation wasn't a target. It was a crisis. It was treated like a national emergency. At the start of the 20th century, most major economies were tied to gold. National currencies were not just paper with pretty designs. They were legally redeemable for a fixed amount of metal stored in vaults. Money was a claim on something physical and scarce. That scarcity made money relatively stable over long periods. It also limited what governments could do. If your money is tied to gold, you can't simply print your way out of every problem. If a government ran a deficit, it had two honest options: raise taxes or cut spending. There was no magic printer button that could conjure new value from nowhere. Inflation, when it did show up, was viewed as a breakdown of discipline, usually tied to war, political collapse, or outright mismanagement. The idea that a government would deliberately aim for persistent inflation would have sounded insane. No responsible policymaker would have stood up and said, "We are targeting a steady erosion of your currency every year." But then, the world hit a wall. The Great Depression of the 1930s blew up the old monetary worldview. Prices didn't rise, they fell. Wages collapsed. Banks failed one after another. Instead of money becoming worthless, the opposite happened. Money became too valuable. Cash gained purchasing power over time. That might sound good at first, but it was deadly for a debt-based system. If your money is worth more tomorrow than today, you don't spend, you don't invest, you hoard. And if you're in debt, every day that passes makes that debt heavier in real terms. The result was a deflationary death spiral. Less spending, more defaults, more bank failures, more fear. Trade slowed, unemployment climbed, the economy froze. Not because of inflation, but because of deflation. This crisis forced a radical shift in how policymakers thought about money. They realized that a currency that only holds or gains value can be just as dangerous as one that collapses. By the end of World War II, a new idea had taken root. Inflation could be used as a tool. A controlled, moderate erosion of money could solve problems that seemed mathematically impossible. After the war, governments emerged drowning in debt. Some owed more than 200% of their annual economic output. There was no politically acceptable way to tax their citizens enough to pay off those obligations. Defaulting outright would have destroyed credibility and possibly triggered political revolutions. So, they chose a third path. They let inflation work in the background. During the 1950s and 1960s, the public story was one of rebuilding, growth, and prosperity. But beneath that surface, inflation was quietly melting away the real burden of government debt. Bonds issued in one decade simply did not mean the same thing 10 or 20 years later. $1 trillion in obligations was still $1 trillion on paper, but the purchasing power represented by that trillion was shrinking. the system had learned a powerful lesson. If you let inflation run at a moderate pace, you can make impossible debts manageable without ever holding a press conference about it. You don't have to say, "We're taking value from savers and handing it to borrowers." The math does that in silence. Then came 1971. Up to that point, the US dollar, the anchor of the post-war system, was still linked to gold for international settlements. Foreign governments could, in theory, trade in their dollars for a fixed amount of gold from US reserves. But rising costs from war and domestic programs stretched that promise to the breaking point. Too many dollars, not enough gold. So, President Richard Nixon closed the gold window. He suspended the convertibility of dollars into gold, officially as a temporary emergency measure. It never reopened. That one decision completed the transition from hard-backed money to pure fiat currency. From that moment on, the dollar was no longer a claim on a scarce metal. It was a claim on itself, on faith, on law, on confidence. You couldn't exchange a dollar for gold at a fixed rate anymore. You could only exchange dollars for more dollars, or whatever someone else was willing to sell you. Money stopped being purely a neutral measuring stick of value, and became a flexible instrument of policy. That shift changed the rules of the economic game. Without a metal anchor, money could be created in essentially unlimited quantities, as long as people didn't lose faith completely. Governments could borrow on a scale that would have been impossible under a gold standard. Banks could expand credit further and faster, and investors discovered a new reality. In a world of managed inflation, the biggest winners were not the cautious savers, but the strategic borrowers and asset owners. Inflation quietly reverses the normal logic of money. If you hold cash, inflation slowly robs you. If you hold long-term fixed-rate debt, inflation pays you. Every year that prices rise, the real value of what you owe shrinks. $1 million mortgage looks terrifying in year one. 2 decades later, after years of inflation, that same monthly payment feels relatively small compared to wages and prices that have marched upward. Meanwhile, the assets tied to that debt, houses, land, stocks, businesses, tend to rise in nominal terms. On paper, they're worth more. So, inflation does 2 things at once. It reduces the real weight of old debt and inflates the sticker price of assets. That combination is incredibly powerful if you own things and borrow strategically. It's devastating if you're trying to save your way into that position. This is the paradox at the center of the modern system. The same force that slowly destroys the purchasing power of the poor and the cautious is the force that sustains and multiplies the wealth of those at the top. It doesn't require a secret meeting or a hidden conspiracy. It's just arithmetic in a credit-based economy. Inflation is the lubricant that keeps a debt-fueled system running. Without it, every dollar borrowed would have to be repaid in dollars that are just as valuable in the future as when they were loaned out. That's incredibly hard to sustain when the system is constantly issuing new credit. So governments, central banks, and large financial players converge, not in public speeches, but in practice, on the same conclusion. Better to let the currency lose a little value each year than to risk a full-blown collapse. But that raises a brutal question. What happens to the ordinary person in this setup? The answer isn't complicated, but it is painful. Wages rarely grow as fast as the broad cost of living. Some years they do, but over a lifetime, most workers find themselves chasing prices rather than staying comfortably ahead of them. Savings accounts, once marketed as the foundation of security for the middle class, turn into slow-motion leakages of purchasing power. If you don't own significant assets and your main income is a paycheck, you end up running on an invisible treadmill. You move, but you don't get closer to financial freedom. Inflation tilts the playing field toward ownership and leverage, and away from labor and caution. The old virtues, frugality, saving, living below your means, get quietly punished. The system still praises them in language, but punishes them in practice. If your bank offers you 3% interest while inflation runs at 6%, you're not being rewarded for saving. You're paying a hidden 3% a year just to stand still in nominal terms. Meanwhile, someone who borrows at 4% to buy a rental property or a business might see the price of that asset climb 10%, 20%, or more over a few years, especially in an environment of easy money and rising demand. That's not just luck. That's how the rules are written. Inflation doesn't spread rewards evenly. it channels them upward. The people closest to the source of new money, central banks, major financial institutions, large corporations, governments, receive that money early before prices fully adjust. By the time that new money filters down to salaries and consumer loans, the cost of living has already moved. This pattern has a name, the Cantillon Effect, after the 18th century economist Richard Cantillon, who noticed that when new money enters an economy, it benefits the early receivers the most. Back then it was kings, court favorites, and merchants with privileged access. Today it's hedge funds, investment banks, and large asset managers. Inflation doesn't just change numbers on a screen. It rearranges who lives comfortably above rising prices and who has to live under them. After 1971, once money was officially unanchored from gold, this logic hardened into the normal state of affairs. The old constraint, that money had to correspond to a scarce commodity, was gone. What used to restrain governments and banks now freed them. Credit expanded, saving in cash became less rational, and inflation, mild, managed, and constant, became the quiet glue holding together an increasingly leveraged world. By the 1980s and 1990s, central banks had refined their narrative. They didn't talk about eroding your purchasing power. They talked about price stability. They framed a steady 2% inflation rate as desirable, almost scientific. It sounded precise, technical, and harmless. 2% is such a small number that it feels irrelevant in daily life. But over 30 or 40 years, that tiny 2% compounds into a massive loss of purchasing power. A dollar can lose half of its real value across a single working lifetime. The grocery bill that your grandparents complained about looks laughably small today, and one day, your complaints will sound the same. The crucial difference is that while ordinary people notice this through rising bills and stretched budgets, those who own stocks, real estate, and businesses see their net worth not only keep up, but often outrun that inflation. Because in an inflationary environment, the rich aren't just holding cash. They hold claims on future cash flows, on land, on infrastructure, on companies that can raise prices and push costs onward. They don't fear inflation in the same way. In many cases, they plan around it, they use it. Governments also benefit. Public debt shrinks in real terms as long as inflation stays positive and growth doesn't completely stall. That's why policymakers are terrified of deflation. Deflation makes debts heavier, it pops bubbles, it reveals over-leveraged institutions. Inflation, even when unpopular, does the opposite. It smooths over cracks, keeps nominal GDP growing, and disguises the true cost of past decisions. Bankers and financial institutions may love inflation most of all. A world where prices always drift upward is a world where saving under the mattress is irrational. You're almost forced to put your money to work. That means more demand for loans, more trading, more products, more fees. Mortgages, corporate bonds, margin loans, complex derivatives. The architecture of modern finance is built on the assumption that tomorrow's money will be worth a bit less than today's. Where you stand in this system depends on how you participate in it. If your income is wages, your ability to adjust to inflation is limited. You can negotiate a raise, change jobs, maybe switch industries, but you're still making linear gains in a world of compounding changes. If your wealth is in assets, inflation often boosts your position as nominal prices climb. And if you live heavily on short-term, high-interest debt, credit cards, payday loans, inflation can wreck you even faster because rates are high and balances compound. On the other hand, if you hold long-term fixed-rate debt used to buy productive or scarce assets, inflation can be your ally. The system is complex enough that two people with the same income can experience inflation in completely opposite ways, depending on what kind of debt and assets they hold. The rich understand this distinction. Most people don't. That's how inflation turns not just money, but information itself into an asset class. Then came the global financial crisis in 2008. That moment could have been a hard reset, a chance to question whether a hyper-leveraged, inflation-dependent system was sustainable. Instead, it became a real-time demonstration of how far policymakers would go to preserve it. Central banks created trillions in new money to stabilize the financial system, but they didn't mail checks directly to every citizen. The bulk of that support flowed through banks, bond markets, and large institutions. It showed up first in the prices of financial assets, stocks, bonds, real estate, long before it changed anything on a paycheck. Equity markets recovered, property markets recovered, the financial sector survived. But wage growth for ordinary workers remained sluggish. The technical term for this intervention, quantitative easing, made it sound sterile and abstract. In practice, it was a massive inflation of asset values, with gains captured disproportionately by those who already owned those assets. It wasn't a scandal in the legal sense, it was policy. It was the logical application of a system that believes stability comes from supporting credit markets first and trusting that the benefits will eventually trickle outward. In 2020, the pattern repeated, but with some twists. This time, a global pandemic shut down entire sectors of the economy. Governments moved faster and more aggressively. They didn't just backstop banks. They also pushed money directly into households through stimulus checks, expanded benefits, and emergency programs. At the same time, global supply chains broke. Goods became harder to move, harder to produce, and harder to source. The result was predictable. Demand was pumped up by new money while supply was constrained. Prices jumped, first in obvious places like used cars and housing, then almost everywhere. Inflation surged to levels not seen in decades. And again, look at who came out on top. Stock markets rebounded and reached new highs. Real estate in many regions became even more unaffordable. Investors who already had capital to deploy bounced back quickly. Meanwhile, renters, small savers, and low-wage workers faced rising food, rent, and energy costs that ate away any temporary benefits they had received. For a brief moment, there was a popular narrative that inflation was caused entirely by greedy corporations. Yes, companies raised prices aggressively. Yes, some took advantage of the moment to widen margins. But greed itself wasn't new. The structure that rewards that greed in inflationary moments has been there for decades. The difference is that in a high inflation environment, the companies and individuals who already understand the game are simply positioned to win bigger and faster. Inflation doesn't pick winners based on morality. It amplifies the advantages of leverage, information, and timing. Look at any major inflationary episode and the pattern repeats. In Weimar Germany, the middle class watched their savings evaporate while those who owned factories, hard assets, or foreign currency emerged in far stronger relative positions. In post-war Britain, moderate but persistent inflation helped reduce government debt but eroded the real value of fixed pensions and savings. In the 1970s, United States stock market stagnated in real terms, but those who owned real estate, commodities, or businesses tied to physical goods had opportunities to build fortunes. In the 2020s, the richest sliver of the population has gained trillions in paper wealth, while median households struggle to stay ahead of rising rents, healthcare costs, and food prices. Different eras, different politics, same underlying formula. Inflation is one of the oldest forms of wealth transfer in human history, and one of the most socially acceptable. It rarely shows up as a headline tax. It doesn't require a bill in Parliament that everyone debates. Instead, it's framed as economic management, stimulus, or stability. People blame supply chains, foreign countries, political parties, corporate greed, and all of those can play a part. But beneath those headlines sits a deeper structural reality. We built an economy that runs on ever-expanding credit, and that kind of system needs inflation to survive. The alternative isn't a fairy tale world of stable prices and painless prosperity. The alternative is brutal deleveraging, defaults, bank failures, collapsing asset prices, deep recessions. That's why, when central banks talk about fighting inflation, their real mission is not to eliminate it permanently. It's to keep it within a range that doesn't trigger outright revolt. They perform a delicate balancing act. Too little inflation, and the system risks seizing up. Debts become too heavy. Speculative bubbles burst, and growth stalls. Too much inflation and public anger explodes. Political pressure rises, and confidence in the currency can crack. So we get a choreographed war on inflation, speeches, interest rate hikes, dramatic headlines, followed by pivots whenever markets start to break. Because everyone at the top understands a simple truth. A little inflation is a small price to pay for keeping the machine running. But inflation doesn't just change the math. It changes people. It reshapes behavior. In a world where prices are always creeping up, the logical move is to spend or invest now rather than save for later. It teaches people to consume immediately, because waiting is punished. It turns patience, once a key to building wealth, into something that feels risky, and it turns speculation into a kind of hope. Maybe the next investment, the next coin, the next stock, the next property will outrun the inflation you're afraid of. This dynamic produces the ideal citizen for a debt-driven system, always slightly anxious, always chasing, always needing to stay in the game just to avoid falling behind. It's a mindset shift as much as a financial one. Inflation becomes not just an economic policy, but a culture. We call this culture growth. We call it prosperity, progress, and the market working. But underneath the optimistic branding is the same cycle repeated over and over. Devalue, reflate, redistribute, reset expectations. Inflation keeps empires solvent, keeps banks liquid, and keeps the majority focused on staying afloat rather than questioning the rules. Once you see this pattern, it's hard to unsee it. Inflation is not random. It is a way of measuring time in terms of power. It rewards those who live in the future, the people who borrow, invest, control credit flows, and plan decades ahead. It punishes those who live only in the present, who trade hours for wages and save what's left in cash. And it quietly erases the financial assumptions of those who live in the past, the people who still believe that a dollar saved is safe in the way it was for previous generations. That's why the rich don't fear inflation the way you do. To them, it's not theft, it's a strategy. It's a background condition they have learned to ride, hedge, and harness. Every generation eventually discovers the same uncomfortable truth. Money is not a fixed unit of value. Its purchasing power is always shifting. The real question is whether you're the one losing that value bit by bit, or one of the few shaping where it goes. Inflation didn't fall out of a clear blue sky. It is the predictable consequence of a world that wants consumption now, and prefers to push the true costs into the future. It is the engine that powers a credit-addicted system, the fuel of empires, the bloodstream of a model that demands growth at almost any cost. And here's the paradox. Without some level of inflation, this model doesn't just slow down, it breaks. Deflation crushes borrowers, implodes banks, freezes trade, and exposes every over-leveraged bet all at once. Inflation, even when painful, keeps the gears turning. It redistributes the pain over time and down the social ladder. That's the moral equation of the modern economy. Preserve growth and stability at the top, while quietly taxing the bottom and the middle through devaluation. So, the next time you hear a politician, economist, or commentator calmly say that a little bit of inflation is good for the economy, ask yourself, good for whom? Not for the worker trying to save a down payment while housing prices sprint away. Not for the retiree living on a fixed pension. Not for the family whose wages lag years behind the cost of living. It's good for the people who already own the house, the ones who own the company that raises prices, the ones who own the assets that absorb and exceed inflation, the ones who designed and continue to maintain a system that only functions if prices never stop creeping higher. Inflation is not a glitch in capitalism. It is capitalism, running exactly as designed, uphill at speed, with your wallet in its pocket. Because in the end, inflation isn't the fire that destroys the system. It's the oxygen that keeps it burning. And the world we've built doesn't know how to breathe without it. If this shifted how you see money, hit subscribe. History doesn't just repeat, it explains. And if you want to understand the future, you need to know where this story really started.